It began, as most great financial stories do, with a man and a dream. Bernard Lawrence Madoff was not born into wealth or privilege. He was born on April 29, 1938, in Queens, New York, the son of Sylvia and Ralph Madoff. His father was a plumber who later worked as a stockbroker after a failed attempt to run his own financial firm. The family was modest by any standard, not poor, but certainly not elite. And for Bernie, this mattered. Because even at an early age, he understood something crucial about American perception was power. And the man who could control how he was perceived could control almost anything. As a teenager, Bernie stood out not for charm, not for charisma, but for discipline. He was deliberate, calculating. He worked as a lifeguard during the summer, and with the money he saved, he made an unusual purchase for a working-class kid from Queens, a stock ticker. That mechanical stream of numbers rolling endlessly across the page captivated him. It was in a sense the language of the gods, the secret rhythm of money. And Bernie Madoff was determined to learn it. In 1960, after a brief stint at Hofstra University and a few law school classes he never finished, 22-year-old Bernie founded Bernard L. Madoff Investment Securities, LLC, with just $5,000 mostly savings from his lifeguard job and a loan from his father-in-law. The company began modestly making markets in penny stocks. But Bernie was ambitious, and he saw an opportunity that others missed. At the time, trading on Wall Street was archaic. Orders were executed manually, delays were frequent, and inefficiencies were everywhere. Bernie realized he could use technology, specifically early computers, to create a more efficient system for matching buy and sell orders. His firm was among the first to use what would become known as electronic trading, long before it became the industry standard. By the late 1970s, Madoff had built a reputation for being fast, reliable, and innovative. He developed strong ties with major banks and brokerages, and he made sure they knew he was the man to go to when speed and discretion were needed. He didn't wear flashy suits or drive exotic cars. In fact, his modesty was part of the brand. Bernie Madoff was the anti-Gordon Gekko, a family man, a straight shooter, someone you could trust with your money. This image would become his greatest asset. But behind the respectable exterior, a different Bernie was emerging. He was fascinated not just by money, but by control. He had a knack for understanding what people wanted to hear and giving them just enough of it. He wasn't selling stocks. He was selling comfort, stability, the illusion of safety. And people bought it. Lots of people. While Madoff's official market-making business grew and became a key player on Wall Street, eventually handling as much as 10% of all trades on the New York Stock Exchange, he quietly launched another operation. A side fund. A special invitation-only investment opportunity that promised consistent double-digit returns, regardless of market conditions. There were no brochures, no cold calls. If you wanted in, someone had to vouch for you. Madoff wasn't just building a client list, he was building a cult. And at the center of that cult was a promise so alluring, so unshakably seductive, that people would suspend disbelief to believe it. The promise of certainty. As financial markets surged and crashed through the 1980s and 1990s, Madoff's fund appeared immune. Year after year, it delivered positive returns, sometimes 8%, sometimes 12%, but never anything too suspicious. It was, in the words of one investor, miraculously boring. And that's what made it so dangerous. Because the true genius of Bernie Madoff was not in how much money he made, but in how ordinary he made it look. What's most remarkable is how Madoff constructed his empire in plain sight. His office at the Lipstick Building in Midtown Manhattan became the nucleus of both a legitimate trading operation and the hidden Ponzi scheme that would later shake the global financial world. On the 19th floor, the firm's legitimate market-making operation buzzed with terminals, phone calls, and traders handling billions in equities. But just a few floors above, behind a separate set of doors, was the 17th floor off-limits to most employees, where the real game was being played. This was not an accident. The compartmentalization was intentional. Bernie ensured that even his own staff didn't fully understand the full picture. A handful of trusted individuals worked in the inner sanctum, manually entering trades into ancient IBM terminals, fabricating paper records, and printing out fake trade confirmations for clients. It was theater disguised as finance, and Bernie Madoff was both playwright and director. But to understand how it grew so large, we must understand who Bernie targeted and why. Madoff's genius lay in his ability to target the right kind of client. He didn't go after retail investors or speculative traders. He pursued foundations, elite universities, country clubs, and the old money elite. He appealed to those who felt too smart to be tricked, too connected to be excluded, and in doing so, he weaponized exclusivity. If you wanted to invest with Madoff, you didn't approach him directly. You were introduced by someone already in the circle. The more you wanted in, the harder it seemed to get. And once you were in, you didn't dare ask too many questions, because the returns steady above market and uncannily smooth were just too good to challenge. Hedge funds, feeder funds, private wealth managers, they all wanted a piece. And those who couldn't get direct access began investing through intermediaries like Fairfield Greenwich Tremont and Ascot Partners. These so-called feeder funds pooled billions from clients across the globe and handed it to Madoff often without conducting serious due diligence. Even European royalty and global banking giants became entangled. Spain's Banco Santander, France's BNP Paribas, and Switzerland's Union Bancaire Privée all had exposure. The scope was no longer confined to Wall Street or the Upper East Side. It was global, and Bernie kept it all under control with one powerful weapon: silence. Unlike most hedge fund managers, Madoff never disclosed positions. He didn't allow online account access. Clients received printed statements in the mail showing a dazzling portfolio of blue-chip stocks and perfectly timed trades. The returns were staggeringly consistent. Too consistent. But that was the point. In an industry defined by chaos, Madoff offered calm. In a world of boom and bust cycles, he promised linear growth. The message was clear: let the rest of Wall Street chase trends. Madoff had unlocked the formula for permanent gain. And because he had been a respected figure for decades, former chairman of NASDAQ, advisor to regulatory bodies, donor to charities, no one thought to doubt him. The media adored him. Industry insiders revered him. Even competitors were intimidated. He seemed beyond reproach. But beneath the polish, the cracks had already begun to form. As Madoff's investor base ballooned, so too did the demands on the scheme. A Ponzi operation depends on constant inflow. There must always be new money to pay off older investors. But as the fund reached tens of billions in assets under management, Madoff had to get creative. He invented trades, backdated them, created fake transaction histories that showed buying at the lowest point and selling at the peak again and again and again. To a trained eye, this was statistically impossible. And yet many chose not to look too closely. Why? Because in the financial world, results often speak louder than reason. And Bernie's results were screaming. He became a myth, a legend, a man whose fund had never posted a losing year, even during recessions, market crashes, and geopolitical turmoil. His name was spoken with reverence in high society circles, and his fund became a status symbol. What no one realized, however, was that the most powerful illusion Madoff ever created wasn't in the numbers. It was in the minds of his investors. He made them feel chosen, and in return they gave him their trust, blindly. By the early 2000s, Bernie Madoff had quietly become one of the most powerful and enigmatic figures in global finance. His fund reportedly managed tens of billions of dollars, yet no one really knew how. Investors didn't ask, regulators didn't push, and the few skeptics who dared to speak out were largely ignored or worse, ridiculed. Among those skeptics was a man named Harry Markopolos, a financial analyst and quant expert who back in 1999 had been asked by his firm to replicate Madoff's strategy. After just a few hours of analysis, Markopolos reached a startling conclusion: the returns were mathematically impossible. The trades Madoff claimed to be executing didn't align with market data. The volumes were implausible. The options pricing was too perfect. It couldn't be real, and so began a lonely crusade. Markopolos compiled detailed data-driven reports, outlining why Madoff had to be running a Ponzi scheme. He submitted them to the Securities and Exchange Commission multiple times each report, more urgent, more detailed than the last. But nothing happened. The SEC, perhaps intimidated by Madoff's reputation, or simply too understaffed and undertrained to fully grasp, the scale failed to act. Again and again. In one of the greatest failures of regulatory oversight in modern history, the agency not only missed the red flags, they dismissed them outright. Meanwhile, Madoff expanded his web of deception. He cultivated relationships with regulators, hosted fundraising galas, and sat on industry advisory boards. His family members, particularly his sons Mark and Andrew and his brother Peter, were deeply involved in the firm's legitimate operations. Whether they knew about the fraud remains debated to this day, but their presence added yet another layer of credibility to the operation. Madoff wasn't just hiding in plain sight, he was the face of respectability itself. As the years rolled on, so did the checks. Foundations entrusted their endowments. Charities handed over life savings. Holocaust survivors' pension funds. Even municipalities all became clients. The more people invested, the more legitimate the fund seemed. And because withdrawals were limited, most left their money in content with the slow, steady returns, and unaware that their profits came from the deposits of other victims. But like all illusions, it was destined to unravel. The cracks that Markopoulos had seen years earlier were widening. Market experts began to question how Madoff's fund could remain so insulated from volatility. Journalists sniffed around the edges of the story. Whispers of doubt floated through private equity circles. Still, the empire held until 2008. The global financial crisis shattered confidence across the investment world. Stock markets plunged, banks collapsed, and suddenly everyone wanted their money back. For years, Madoff had managed redemptions, carefully relying on new investors to pay off the old, always keeping enough liquidity on hand to satisfy minor withdrawals. But 2008 was different. Investors panicked by collapsing portfolios elsewhere, demanded billions in redemptions, and there were no new investors coming in. The flow had reversed. The pyramid built so carefully over decades was beginning to crumble. On December 10, 2008, Bernie Madoff sat down with his sons and confessed. It's all one big lie, he told them. The fund, he admitted, was a fraud, a Ponzi scheme. 65 billion in client accounts gone. Fabricated. Fake. His sons turned him in the next day. The financial world was stunned. The myth had shattered. Bernie Madoff, the man they had trusted, celebrated, revered, was a fraudster of historic proportions. In that moment, a new era began. But to understand how he fell, we must first understand how he built his house of cards so perfectly. The next chapter reveals the architecture of the con, the meticulous mechanics of the greatest financial fraud in history. Bernie Madoff didn't just build a Ponzi scheme, he built a masterpiece. It wasn't the largest because of scale alone. It was the largest because of brilliance. His fraud endured for decades, not simply because he lied, but because his lie was beautiful, elegant, symmetrical, hidden inside the folds of a financial system that rewarded confidence more than competence, reputation more than regulation, and familiarity more than scrutiny. At its core, a Ponzi scheme is simple. New investors' money is used to pay earlier investors who then spread the word about their incredible returns. This attracts more investors, more money, and more false profits until the scheme collapses under its own weight when the flow of new money dries up. It's a ticking time bomb with one critical dependency: trust. And trust was Bernie Madoff's greatest currency. He didn't promise 30% returns or flashy charts with exponential spikes. No. Madoff's genius lay in moderation. He promised just enough. A steady 10 to 12% per year. Smooth upward growth that seemed prudent, even boring when compared to the wild swings of the market. To the financially sophisticated, his strategy looked like an oasis of stability. But here's the thing, real investing is messy. Even the best hedge funds have down months, bad trades, unexpected losses. Markets fluctuate. Madoff's fund did not. That should have been the red flag. But no one wanted to see it. Because what he offered was not merely profit. He offered certainty in a world defined by chaos. To keep up appearances, Madoff and his tight inner circle on the 17th floor of the Lipstick Building engaged in relentless fabrication. Every month, thousands of fake trade confirmations were generated manually. His team would choose a list of blue-chip stocks companies like IBM, Microsoft, and General Electric, then fabricate buy and sell dates that perfectly bracketed price movements. It was like being able to go back in time and always buy low and sell high. To investors receiving those statements, it looked like genius. In reality, the trades never happened. The money was never in the market. It was in a chase account sitting idle, used only to pay out withdrawals. And yet even professional investors bought the illusion. How? Because Madoff was untouchable. He'd been chairman of NASDAQ. He was a pioneer in electronic trading. He donated to charities, attended high society events, and employed his family in key roles. Everything about him radiated credibility. He made clients sign non-disclosure agreements, told them to keep their involvement quiet, lest others flood the fund with capital. He created artificial scarcity, closing the fund, periodically refusing new money, unless it came from approved circles. The more secretive he became, the more desirable his fund appeared. This is how Madoff turned due diligence on its head. In traditional investing, secrecy raises alarms. But in Madoff's world, secrecy was prestige. Clients competed to get in. Country club members, hedge fund managers, European nobility, they whispered about getting access to Madoff. His name carried weight, not because of what he revealed, but because of what he didn't. But the most dangerous enablers weren't his clients. They were the financial institutions and regulators that stood by and did nothing. Feeder funds were Madoff's most powerful weapon. These weren't mom-and-pop investors. They were sophisticated institutions managing money on behalf of thousands of clients. Funds like Fairfield Greenwich Tremont Group and Ascot Partners funneled billions into Madoff's operation, earning hefty fees along the way. They performed virtually no due diligence. Why should they? The returns were perfect. Clients were happy. And as long as the money kept flowing, no one had an incentive to look too closely. In many cases, these funds charged their clients a percentage of assets under management plus performance fees, while simply turning that money over to Madoff. They didn't manage the money, they just acted as middlemen, and they made fortunes for it. Some insiders at these feeder funds did express quiet concerns. There were whispers about the impossibility of the returns, about Madoff's refusal to allow audits or explain his strategy in detail. But skepticism was squashed by greed. When billions are rolling in and clients are euphoric, the incentive to question is weak. The incentive to ignore is overwhelming. But it wasn't just the funds that failed. The United States Securities and Exchange Commission, the SEC, was warned repeatedly. Harry Markopolos submitted detailed reports complete with mathematical analysis, trade volume, inconsistencies, and outright accusations of fraud. He even titled one submission, "The world's largest hedge fund is a fraud." The reports sat unread. Investigations were launched half-heartedly. In some cases, SEC examiners would visit Madoff's offices and allow his staff to handpick the documents they reviewed. They were wowed by his prestige, his confidence, his reputation. They never demanded trading records from the depository trust company, the one place that could have proven the trades were fake. Even when whistleblowers within the financial industry echoed Markopolos's warnings, the agency brushed them off. Madoff was too big to doubt. His resume was impeccable. His firm had survived multiple market crashes. The very idea that he was a fraud seemed unthinkable. But that's the trick with illusions. The more perfect they seem, the less likely we are to challenge them. Madoff understood this. He cultivated that image relentlessly. His office was modest, his demeanor soft-spoken. He didn't boast. He avoided media attention. His personal wealth, though enormous, was never flamboyantly displayed. And yet, he owned multiple homes, luxury cars, yachts. But he knew how to keep it quiet, to stay under the radar, to be just believable enough. Behind the scenes, he kept meticulous control. He limited access to internal systems. He ensured that his inner circle didn't talk. Many of them, it seems, didn't even know the full extent of what they were involved in. Some believed they were executing trades using a black box strategy. Others may have suspected, but feared the consequences of asking questions. It was in every way a fortress built on a mission. But that fortress had cracks. The volume of fake trades increased with every new investor. The paper trail became more complex. And as Madoff's global reach extended, his fraud required more and more silence from more and more people. Silence eventually becomes fragile. Still, for nearly 40 years it worked. During this time, charities entrusted him with life savings. Holocaust survivor funds invested with him. Universities placed their endowments into his care. Even financial institutions that prided themselves on risk analysis and due diligence bought in. In truth, Madoff didn't trick Wall Street. He exposed it. He exposed how easily prestige can blind caution, how due diligence collapses when incentives are misaligned, how gatekeepers fail when they fear embarrassment more than risk, and how a single man armed with charm spreadsheets and a whisper network could outwit the entire financial apparatus of the most powerful country on earth. It's tempting to view Madoff as an anomaly, a monster among men. But that lets everyone else off the hook. The feeder funds the regulators, the banks, the auditors. They weren't victims. They were enablers. They didn't ask questions because they didn't want answers. And so the lie grew. The brilliance of Madoff's scheme wasn't just in the mechanics. It was psychological. He understood, perhaps better than anyone, that in the world of finance, belief is everything. If people believe their money is safe, they'll defend it, even when the numbers stop making sense. Many of Madoff's investors weren't just wealthy, they were influential. Celebrities, philanthropists, hedge fund managers, Nobel laureates. They had built their lives on reputation and intelligence. Admitting they had been duped would mean admitting they had missed something obvious. That shame kept them silent. Some would rather lose millions than lose face, others genuinely believed. Because how could someone like Bernie, quiet, generous, fatherly Bernie, be lying? He donated millions to hospitals, to the arts, to Jewish charities. He hired family. He built trust. He shook hands. He remembered birthdays. He sent handwritten notes. In a world of ruthless sharks, Bernie Madoff felt safe. And in a cruel twist, the people who most needed stability, the elderly, the cautious, the conservative investors who stayed out of speculative markets, were the ones most drawn to him. They were told by financial advisors, by friends, even by rabbis, put your money with Bernie. He's safe. But by 2007, there were signs. Small ones barely audible beneath the hum of confidence. A handful of journalists began asking questions. Certain hedge funds quietly divested. And beneath it all, Madoff himself knew the end was near. He once told a close associate, "I'm at the end of my rope. The pressure is unbearable." He began turning down new investors not out of ethics, but because he feared getting caught. His inner circle noticed changes, mood swings, paranoia, long hours at the office. Then came 2008. The financial crisis didn't just rock Wall Street, it obliterated the very notion of trust in global markets. Lehman Brothers collapsed. Bear Stearns vanished. Confidence evaporated. Investors everywhere began pulling money out of hedge funds, demanding liquidity, safety, certainty. Madoff's clients were no exception. In the span of weeks, he was hit with redemption requests, totaling billions, far more than the few $100 million he kept liquid. He tried to stall, tried to buy time, but the truth was inescapable. The new money had stopped, and the old money wanted out. There were no reserves, no rainy day fund, no emergency strategy. Because in a Ponzi scheme, there is no plan B. It all unraveled in silence. No headlines, no warning bells. Just one man staring at a ledger, realizing the math no longer worked, realizing the game was over. On December 10, 2008, in a quiet moment in his Manhattan apartment, Bernie Madoff told his sons the truth. It's all one big lie. They were stunned, horrified. They called lawyers. The next day, they turned their father in. On December 11th, FBI agents arrived at Madoff's home. "We're here to find out if there's an innocent explanation," they said. "There is no innocent explanation," he replied. It was over. Decades of deception, billions of dollars, the lives and dreams of thousands collapsed in a single sentence. And yet, even as Madoff was arrested, even as the news spread, even as the headlines exploded across every major outlet, many couldn't believe it. Not Bernie, not him. But it was him. And as the truth came into focus, as the victims came forward, as the scale became undeniable, a new question emerged. How had no one seen it? The answer, of course, was that many had. They just didn't want to look. The morning after Bernie Madoff's arrest, the financial world woke up to a nightmare it didn't yet know how to process. Newsrooms were scrambling, phone lines at investment offices were flooded, foundations, charities, private investors, people across continents were gripped by the same paralyzing question. Is our money gone? It was. Overnight, the so-called Wizard of Wall Street had transformed into the architect of the largest financial fraud in history. The figure was staggering $65 billion in fabricated account statements, $19 billion in principal stolen, and an untold number of lives shattered. The victims were everywhere. Elderly retirees who had entrusted their life savings. Holocaust survivors who had placed their compensation funds in Madoff's care. Universities and hospitals that saw endowments wiped out. Charities forced to close overnight. Families that had spent generations building wealth now left penniless. Among the most devastated was the Elie Wiesel Foundation for Humanity, a non-profit founded by Holocaust survivor and Nobel Peace Prize winner Elie Wiesel. They lost over $15 million. Wiesel would later say, "We thought he was God. We trusted everything in his hands." The sense of betrayal wasn't just financial, it was moral. Madoff hadn't simply stolen money, he had stolen futures, legacies, hope. The legal machinery activated quickly but clumsily. Victims wanted justice, the public wanted retribution, lawmakers wanted to save face, and the SEC, scrambling to explain why they had ignored warnings for a decade. Congress held hearings. Journalists dug into the mountain of ignored evidence. Harry Markopolos was suddenly everywhere, explaining with methodical precision how the fraud could have been detected in hours. The SEC, under pressure, issued apologies, launched internal reviews, and reshuffled leadership. But for many it was too late. The trust that underpinned the financial system had taken a blow more devastating than even the 2008 crash. Because Madoff didn't just steal, he appeared to prove that the system itself was broken. Meanwhile, the mechanics of recovery began. Irving Picard, the court-appointed trustee tasked with recovering assets for Madoff's victims, began an unprecedented legal campaign. His mission was complex: trace every dollar, sue every feeder fund that failed to perform due diligence, claw back false profits, even from innocent investors. This approach was controversial. Some investors who had no idea the fund was a fraud were forced to return gains they had already spent. Others who had lost everything were told they might receive only a fraction in restitution. As of today, over $14 billion has been recovered, a record for any financial fraud, but many victims still wait. Then came the collateral damage. Bernie Madoff's two sons, Mark and Andrew, had turned their father in, but they couldn't escape the fallout. Though never criminally charged, they were vilified in the press. Their personal and professional lives collapsed. Mark, consumed by the shame and pressure, died by suicide exactly 2 years after his father's arrest. He hanged himself in his Manhattan apartment while his 2-year-old son slept in the next room. Andrew died of cancer in 2014. Their deaths became a tragic coda to the Madoff saga, a reminder that no one, not even those closest to the fraudster, escaped unscathed. Meanwhile, Ruth Madoff, Bernie's wife of over 50 years, was ostracized. Though she claimed to have no knowledge of the fraud, her family, her friends, and even the press turned against her. She agreed to forfeit millions in assets and now lives in near anonymity. But what about Bernie? As the FBI unraveled the full scale of the deception, Madoff was kept under house arrest in his $7 million penthouse. He remained mostly silent. No public apology, no interviews. When asked why he did it, he would later tell authorities, "I thought it would end someday. I thought I'd be able to unwind it before it got too big." It was already too big. In March 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, mail fraud, money laundering, and perjury. He offered no defense, no plea deal, no trial. In court, he simply said, "I am deeply sorry and ashamed. I cannot adequately express how sorry I am." The judge sentenced him to 150 years in prison, the maximum allowed. It was a symbolic sentence, a message to the world that white-collar crime on this scale would be punished to the fullest extent. Madoff was shipped off to a federal correctional facility in Butner, North Carolina. His empire gone, his name now synonymous with deceit. But as the dust settled deeper, questions remained. How could one man fool the entire financial world? How could so many smart people fall for such a basic scam? Why did regulators fail? Were there others like him, smaller, smarter, still undetected? Madoff had built more than a fraud. He had built a mirror. And in that mirror, the world saw the truth about itself. Bernie Madoff's empire wasn't built on complex algorithms or technological wizardry. It was built on a simple premise people want to believe. They want to believe in security, in certainty, in someone who has all the answers. Madoff offered that wrapped in the language of modesty and discipline. He didn't overpromise. He didn't brag. He gave the illusion of control in a world that was spinning out of it. And that more than anything is why it worked. Because Madoff's fraud wasn't just financial, it was emotional. He gave people comfort. He gave them sleep. In an unpredictable market, he was the steady hand. And so they handed over everything, their retirement, their legacy, their children's future. He didn't demand it. They offered it willingly. This is the uncomfortable truth no one wants to admit. Madoff didn't con the world alone. The world helped. Feeder funds prioritized profits over principles. Regulators feared embarrassment more than failure. Journalists ignored leads. Banks processed billions without asking questions. And investors armed with spreadsheets and MBAs and decades of experience willfully ignored the red flags because the lie was easier than the truth. Even now in hindsight, there's a temptation to see the Madoff case as exceptional and outlier. But it wasn't. It was a reflection of the system itself. A system where due diligence is often performative, where reputation overrides reality, where risk is outsourced and success is confused with virtue. Madoff simply played by those rules better than anyone else. And that's why his story still haunts. Not because he fooled a few people, but because he fooled everyone. And not with genius, but with consistency. He showed us how fragile trust really is, how quickly it can be weaponized, how easily it can be monetized, and how devastating the consequences are when it's broken. But perhaps the most unsettling part is this: Madoff never ran, never tried to flee. He had yachts, passports, connections. He could have vanished. But he didn't. Why? Some say it was guilt, others say it was arrogance, or maybe, just maybe, it was because even he believed the illusion. Because that's the final twist of the Madoff saga. That in the end, even the man behind the curtain may have forgotten it was a curtain at all. In the years following Bernie Madoff's downfall, his name became shorthand for betrayal. Pulling a Madoff entered the lexicon. His mugshot became a symbol not just of crime, but of hubris, of how one man, smiling, tailored, silver-haired, could quietly dismantle the financial lives of tens of thousands and walk undetected among the world's elite. Behind bars, Madoff wasn't the financial titan he once appeared. He was inmate, room 61727-054. He mopped floors, folded laundry, and handed out peanut butter in the commissary. His days of boardrooms and black tie galas had vanished, but even in prison the myth followed him. Fellow inmates sought his advice. Some viewed him with awe, others with contempt. He reportedly told one inmate, "I'm the guy who made them all rich, until I didn't." But justice, as always, was complicated, because for every headline about Madoff's sentencing, there were quiet tragedies unfolding around the world. Couples divorced, homes were sold, retirements postponed, families torn apart by blame, shame, and loss. Many victims died before receiving restitution. Some, unable to rebuild, died by suicide. The numbers couldn't capture the emotional wreckage. $65 billion wasn't just a number. It was years of labor, sacrifice, and trust reduced to ash. And yet, amid the ruin, there were those who asked the bigger question: what now? In the aftermath, sweeping reforms were promised. The SEC vowed to overhaul its processes, restructure its enforcement division, and strengthen whistleblower protections. Congress debated new oversight measures. Financial firms raced to enhance their internal compliance departments. But change came slowly and not nearly enough. Because the truth is, the Madoff scandal didn't happen in a vacuum. It was a symptom of a culture that celebrates wealth, worships reputation, and penalizes doubt. A culture where asking hard questions is seen as disloyal, and where the phrase "too good to be true" is often ignored because it's also too convenient to challenge. Madoff's story should have been a reckoning. Instead, for many, it became background noise. New scandals emerged. New crises took center stage. The world moved on. But underneath the same incentives remained reward short-term results, punish transparency and trust charisma over credentials. Still, there were lessons if we chose to learn them. Lesson 1. Fraud thrives in silence. Every whistle ignored, every red flag dismissed is a brick in the foundation of a con. Vigilance requires courage not just from regulators, but from peers, partners, and clients. Lesson 2. Complexity doesn't equal legitimacy. Madoff's scheme was simple. What protected it was the complexity of the financial world around it. The layers of intermediaries' jargon and unchecked assumptions all served as camouflage. Real due diligence isn't about ticking boxes, it's about asking uncomfortable questions. Lesson 3. Trust is not a substitute for transparency. Madoff's greatest asset wasn't his strategy. It was his brand, his handshake, his quiet confidence. But trust unverified is dangerous, especially when paired with exclusivity. He made people feel lucky to be included, and that's precisely how he controlled them. Lesson 4. No one is immune. Not Nobel Prize winners, not investment banks, not government agencies. The smarter you are, the more susceptible you may be because your ego tells you that you would never fall for it. And perhaps the hardest lesson of all, sometimes we want to be lied to because the truth is volatile, messy, risky. It means markets crash, strategies fail, and no one has a crystal ball. But the lie is smooth, predictable, easy to sell. Madoff sold that lie better than anyone in history. So what remains? Bernie Madoff died in prison on April 14, 2021 at the age of 82. There was no ceremony, no monument, just a quiet footnote in a system still grappling with the monster it helped create. His empire, a web of deceit spun over decades, was dismantled, but the shadows it cast still stretch across the world of finance. Every Ponzi scheme uncovered today, every fund that collapses due to deception, carries echoes of Madoff. And every time a regulator hesitates, or an investor skips their research, or a firm chooses image over integrity, that's his legacy too. But perhaps the most chilling part, he didn't need to be clever. He just needed people to stop asking questions. And they did.